This video is being recorded on Wednesday, July 5th, 2023. Thank you so much for tuning in. If you haven't already, please click the subscribe button. I'd really appreciate it. In this video, I'm going to lay out the potential new macro development to look for. And essentially what we're talking about here is the market discounting inflation being really, really sticky, even as the Fed comes to the end of its rate hiking cycle. And in recent videos and interviews, I've been talking about this for weeks and weeks. Gold needs the steepening of the yield curve, and the way that happens in the majority of cases is it's a deflationary steepening or kind of a disinflationary steepening, where basically the stock market rolls over because a recession is coming. The market discounts that, and short-term bond yields really plunge as capital looks for that safety, and because of that, the yield curve steepens, and that's the trigger for a recession and the Fed cutting rates, and of course gold outperforming, precious metals doing really well, et cetera, et cetera. However, you can also have an inflationary steepening of the curve, and that is when long-term rates rise faster than short-term rates. And so I want to get into that and some of my inflation indicators here. So we have quite a few things here on this chart. This is an inflation expectations ETF, RINF. This is the 2-year yield, 10-year yield, XME. That's the materials ETF, so very correlated with commodities, XLE energy stocks, COPX copper stocks, and then we have the yield curve. So this is the move that's bullish for gold when you see the yield curve going like that. So starting off, just generally look at these charts. I mean, we saw this big move up, with the inflation. And, if you think about the last couple months, I mean, the 2-year yield failed to break down here, inflation expectations holding here. Now it's starting to move away from that and higher. I mean, same thing with these other markets here. I mean, the 10-year yield, how many times is it held above 3.4? Today it's actually up to 3.93, so it's even higher. This chart won't be updated until after the close. And here we see energy stocks, and you have this support. It's holding here. Copper stocks, this holding here. So if you look at all these charts, what they tell you is that there is a threat of a move to the upside. It looks like the path of least resistance right now for all these things is higher. And, if you think about the big picture macro, the stock market bottomed last October. It's rebounded. The rebound is gaining traction. And it's definitely a contrary type of move because, even as recently as several months ago, the market was under-positioned in stocks. The majority was out of stocks, positioned for a recession. And so when the market moves higher, then those people got to buy stocks and get back into the market. And so there's still probably some legs to that. And if these, and by the way, it was led by tech stocks, but if the recession is pushed out, like let's just say now, maybe the market thinks it's not coming for 6 or 7 months at the absolute earliest, maybe 9 months. So if the recession gets pushed out and the Fed is going to be done hiking very soon, that means inflation is still a threat. And again, look at these charts. What do they tell you? The path of least resistance looks to be higher. I mean, look at the inflation expectations ETF. This is pretty bullish, pretty close to testing this high. Again, same thing, the 2-year yield, that makes sense because it follows the Fed. 10-year yield, going to be much closer after today. And you look at these charts, they're not quite as strong as some of these, but I mean, you get the point. There's threat to the upside. There is a threat that these things could make new highs. And so in essence, the capital started moving into stocks, started out with tech stocks. Now it's broadening a little bit. But again, Fed's going to be done hiking soon. And maybe investors in the market, they're worried about, inflation is going to be sticky. Maybe they're worried inflation might reaccelerate after the Fed is done. And again, there's no recession, so that seems possible. And so, precious metals will get a lift because of that. And the key thing to watch for is the yield curve and the inflationary steepening. We need it to go like this and make this big move higher. We as precious metals investors, gold bugs. So the real key to watch for then is the 10-year yield rising faster than the 2-year yield. And so the 10-year yield, if it breaks out here as the Fed is done hiking, they're done hiking after a couple more hikes. So what happens to the 2-year yield? It'll fit, the Fed does the hikes, it goes up a little bit more, and maybe it fizzles out here. But then the 10-year yield breaks out, Fed's done hiking, it keeps rising. Boom. That's how you get the steepening in the curve. I'm not predicting this is going to happen, but this is just something I'm laying out here because, again, the recession looks like it's delayed. It looks like, I could be wrong, but it looks like it's not going to happen in the next 3, 4, or 5 months. Maybe sometime in the next 6, 7, 8, 9 months. So there's still time where you can have this inflationary move to the upside and an inflationary steepening of the curve. And so if you have an inflationary steepening of the curve, that's how gold breaks out. And so moving on to gold, this is really important because underlying all of this is the fact that gold has been holding up really well. Now, look, I know that silver hasn't held up well. I know that the miners aren't holding up well. The juniors, they're not holding up well. I get it. But, gold is the most important thing in the sector. And look, it's holding up really well. I mean, this is the correction. I mean, I know there's distribution here. I mean, there's some ugly candles here. You see it on the monthly chart. But, a couple of days ago, end of the month, end of the quarter, bears had every chance to push this below 1900. They failed. I mean, this is a bullish hammer here. So gold is holding above 1900. And so I think, it's early to say this, but, the scenario of an inflationary steepening of the yield curve, that would keep gold above 1900, and have it rallying back to 2000. Maybe it doesn't break out immediately. Maybe it consolidates, it tests, consolidates for a couple months, breaks out after that. But, that this is a scenario that the probability to me is rising. Now, at the same time, gold has got to outperform the stock market. We need to see a bounce improvement here for gold to break out, get back above 1980 to 2000 on the weekly chart. So those things are important. So I know I'm rambling and babbling on here, but that's the larger point is there is potential for an inflationary steepening. Now, sure, as the weeks and months go by, if we get an inflationary steepening, that doesn't mean the recession is not going to happen. So, in theory, gold could break out, have this big move when you have the inflationary steepening, then the recession hits. Then gold has the correction, which everybody and their mom are waiting for, and everybody and their mom are certain is going to happen. Look, I'm telling you, number one, the correction, this is my prediction, the correction's not going to be as big as people think. And number two, when we get that correction, gold is going to be at a much higher price. That's it for this video. Thank you if you stayed all the way to the end. Let me know what you think. Leave a comment. I'll see you guys again in the next video.